Good afternoon. This is Tom Alexander. It is Thursday, March 6th. This is a special stock market update. Um, if you want to, you can see all the charts that I'm going to share with you in this update. If you go to my website, alexandertrading.com, click on weekly update. This is free. You don't have to buy anything or sign up for anything. Click on special stock market update. And by the way, you can also see previous weekend reports that I do for free. You can see past special stock market updates if you choose. You can see the videos. I have a PDF that you can download the charts, etc. If you want to receive notification when I do this stuff, send me an email to Tom at alexandertrading.com and I will put you on the list. If you find value in the video, please like and subscribe. It helps with the algorithm. By now, most of you know how that works. I would appreciate that very much. Okay, let's talk about the markets. We are at major, major inflection points in the US indices, and something has to give very, very soon here. I'm going to walk you through all the reasons why. Let's just start with the SPX. So the SPX is now down from top print to bottom print about 7%, which is not that big a deal, but it's been pretty relentless off this top. And you can see we have traded right into a very important downside key reference area. And there's been no bounce. Now, there has also been no capitulation. We haven't had that waterfall, scary decline. We've had the one-day wonder declines that have been immediately retraced, and then that's been retraced. So it's been a chop and churn really since the end of February. It's sort of been a grind lower, which is another reason to expect a sharp move here. There's so many reasons to be looking for a sharp move here very, very soon. What I mean by soon, I mean in the next two, 3 trading days on the outside. So this is where the SPX is. You can see we took out the low from earlier this week. That's important to note. If we go to the NDX, it is in a similar position as the SPX. It took out this week's low and is perched on top of, now it's down about 10%. It's perched on top of an important key reference area. If we go to the Dow now, the Dow is interesting because it has not taken out this week's low yet. And this is the equivalent downside level that is important. And then if we go to the Russell, here's the Russell. The Russell has not taken out this week's low yet. Below this area, no telling where it stops. This would be a guess. This area right in here would be probably the next level to take a look at. And then the New York Composite that I like to look at because it's broad and it's showing a lot of relative strength. I mean, off this recent decline, it's only down about 4%. And you have to go all the way down to this area in here. Now, it also has not taken out this week's low. Now, this divergence among the indices here with not having taken out, they're a little bit out of sync where the NDX and SPX have taken out their weekly lows. The Dow, the New York Composite, and the Russell have not. That can be construed as bullish. But what it does do, it adds to this. My bigger thesis here is that we're on the cusp of a really sharp move. We're going to get a face ripping rally, or we're going to get that capitulation decline that I think a lot of people are looking for, which actually may be evidence that we're going to get the face ripping rally. But either way, you're going to get a sharp move and you need to be trading accordingly. That gets into the individual's trade plan, the different time frames you trade, etc. Okay. Okay, let's take a look at this. This is an interesting view. Okay, this is a 30-minute chart of the S&P, the SPX. Below it is breadth, and what we have now, we have a multi-day balance area right here. This is the balance area right here, and then just below this balance area, we have another balance area that was formed by trade this afternoon. So this is the balance area. Then we had the market attempt to break lower, and we ended up in balance most of the afternoon, and that's where we closed. Now, the really interesting thing about this is if you go back, this is that downside level that I have highlighted on the daily chart. This is an absolutely critical level. Now, adding to the confusion, but also adding evidence to the inevitability, the increasing inevitability and probability of a sharp move. We have a divergence here between breadth and price at today's low. In a bull trend, this is unequivocally bullish. Are we in a bull trend? I don't know, but you're going to get a resolution. This is going to be really, really sharp. All right, let's go over here. VIX spiked today. VIX is the highest it's been since mid-January. It's the highest it's been all week. It's the highest it's been this year, et cetera, et cetera. And again, you can very clearly see we have spiked into this downside key reference area. So, maybe we're going to get that sudden VIX spike to 30 or 30 plus, or you're going to get the face ripping rally. And then if we do get that face ripping rally, the area to keep an eye on, immediate area, will be up here this week's highs, really. Okay. And then let's take a look real quickly at one more internal piece of information. NYSE data. This is a 10-day, the red is a 10-day moving average of NYSE advancing issues. Green is a 5-day. The blue is a histogram of closing breadth. And again, we don't have that negative 2000 breadth reading that it gives really good information and typically occurs within a day of at least short-term lows. And that's true even in bear trends. So it would be great if we got, and we're right at that 200-day moving average that everybody's fixated on. So the reasons for a sharp move away from this area are several, but they're probably more than I named. But I'm giving you a heads up. There's going to be a sharp move here. Just go to if you're position trader, go to your intraday charts and look at a 30-minute time frame. And if we start making higher highs and higher lows, you want to be long. If we continue to make lower lows and lower highs, you want to be short. Guys, enjoy the rest of your day, and I'll speak with you again soon.